a good set of numbers. So just heading into the market opening, lots of big cues today. So there you have it. The first tick on the index is in the green, up about 10 points. So very quiet, but with a bit of a green bias to it, which is, I guess, what the street would like. Okay, now drifting into the red. So suffice to say, very, very flat opening. It is led by Kotak and Reliance on the downside. So these are the big index losers. Kotak Mahindra Bank down 2.5% and Reliance down almost about 2%. Apart from that, you have Apollo Hospitals, Eicher Motors, Grasim, that are a couple of other stocks that are in the red right now. And Asian Paints is also trending lower, down about 0.3%. Bharti Airtel, after Reliance's numbers, Bharti Airtel is slightly soft as well. So just keep your radar on that. On the upside, Infosys is coming back a little bit, up about 1%, followed by HDFC Life. A decent set of numbers this time from HDFC Life, actually, and that stock has not performed at all in the last many weeks and months. The AP growth for HDFC Life came in at 13%. The VNB margins were 26% plus. And remember, the stock has corrected below its 20 and 50-day moving average. So HDFC Life could be one stock on the upside. Apart from that, all the IT names, Infi, HCL Tech, Wipro, all in the green. Tata Motors comes out with numbers tomorrow, so just keep an eye out on that. 0.3% higher there. Hero MotoCorp also in the green. So now very, very quiet for the frontliners. But in the broader markets, there are some good result reactions.
Well, that's right, Sonia. In the broader markets, you have Aarti Drugs. The stock is up and about. Utkarsh Small Finance Bank. It had a good listing. Stocks building onto those gains. Volumes as well tremendously high. It's up more than 10% odd. You have Titagar Rail Systems as well. That stock as well has opened up well in the green. And RVNL as well. That stock continues its march upwards. Suzlon Energy, now it's a 20 rupees stock. It's up close on 4.5%. And volumes very, very high. Ircon as well joins the list with a gain of closer around 3%. On the flip side, Vedanta's under some pressure. The rising debt is something the street doesn't like too much. RBL Bank has moved into the red as well. And Canara Bank more or less flattish ahead of its numbers. But par for the course kind of opening, 19,720 odd.
Nigel, even without any great help from the big earnings over the weekend, I mean, the index is doing just fine, right? I mean, 15, 18 points lower, which is neither here nor there. It's flat for what it's worth. So, yeah, I mean, right out of the gates, big volumes on so many names across the board. And the big winner seems to be, of course, CreditAccess with that 6-7% kind of a pop. Aarti Drugs is the other one, which is up about 10-11%. And again, volumes here too seem to be pretty solid. But other than that, let me just kind of quickly scan this list here to see what else is happening. IRFC, all these rail PSU rail companies, IRFC, Railtel, Ircon, RVNL, they were all up between 4 and 8% on Friday, and I think they pick up where they left off with strong gains. Dodla Dairy will come up on your screen. These dairy companies, again, 2 or 3 days in a row now, Parag Milk, this one, Hudson Agro, these have been buzzing. So that, again, once again continues. SJVN, let's have that one up, Satluj Jal Vikas Nigam, that is 9% higher. So that's a big one. We had that note from Goldman last week, I think middle of last week, where they were highlighting some of these names, NHPC, NTPC, SJVN, etc. Mazgaon is up about 3%, apart from what we've already mentioned. On the downside, maybe 1 or 2 names, Kotak, Reliance, Vedanta. You've got AU Bank, all lower. JSW Steel, JSW Steel saw a spike on Friday right out of the earnings, but then kind of slumped, and it's down another 1%. Or so. So that's what we have. Sonia.
By the way, PVR Inox is at a fresh high. So whether you like Barbie, whether you liked Oppenheimer, there's one person laughing all the way to the bank, right? And that's PVR. It was almost 300 crores, by the way, the collections on Barbie on day 3. Yeah, no. So that's been phenomenal.
It's been. I mean, so PVR are doing well on your screen. Well, Dheeraj Agarwal is now joining us, Managing Director at Ambit Capital. Dheeraj, great to have you with us here on the program.
Hi, morning.
Glad you could make it to the studios. Raining still outside? And
Not really right now. It's been nice to be back at the studios rather than on the Zoom.
It's great to have you here.
Great to have
so
you.
Impersonal, yeah.
How are things looking, Dheeraj?
So not too bad, I would say. So markets had a fantastic run. So a little bit of a sideways consolidation here is not completely unwarranted. But overall outlook continues to be good. I think by and large the earnings season has started off well with a few disappointments here and there, which is par for the course. So, but at this point of time, clearly market is looking for growth. I call it the growth chase. So any company sector which is reporting good growth numbers or relatively better growth numbers as compared to its peers or other sectors are finding favor in the market at
We
this
got
point.
one big dhamaka of earnings, right? Polycab, where, I mean, it was big beat.
Yeah.
Apart from that, we've not seen very much by way of meaningful earnings upgrades. Numbers
That's
have met, etc. But that's yet to come. Maybe it'll come. We're still early in the
Yeah, so
results season.
it's a very diverse kind of earnings performance at this point of time if you see, right? So when Polycab is one extreme example of a fantastic set of numbers. So, I mean, if you see one thing which is there is that on the demand side, on consumer demand, we saw that in Hindustan Unilever numbers as well. That's beginning to look a little bit weak. But at the same time, on the investment side, the gravy train just continues. So we are seeing good credit growth, good amount of capex growth, etc. So that relative shifts keep on happening in the market at all points of time. And stocks are rotating very, very fast in the current cycle as compared to what we have seen before.
Okay. By the way, I just want to mention that the headline index may be flat, but there's plenty beneath the surface that's doing very well. I mean, just look at this, right? SJVN is up almost 7%. CreditAccess Grameen is now up almost 7% as well. And we were pointing a couple of these stocks like PVR that are hitting fresh highs. Canfin Homes is up almost about 5-odd%. APL, Apollo Tubes. So there's plenty to choose from. But I wanted your thoughts, Dheeraj, and good morning once again, on banks, right? The numbers are good, but the rally has also been pretty sharp. I mean, ICICI Bank is up over 20% from the lows in March. Do you think there is further scope for re-rating?
I think there is. It will not be as sharp as what we have seen in the initial part of the re-rating, right? So a lot of valuation discovery is already done. From here on, to expect the kind of movement that we saw in banks in the last 2 years is not going to be easy. In fact, even at the index level, it's going to be more moderate than 12% per annum kind of a performance. So it's not that market's going to run away despite a very strong economy, because there are, as we discussed right now, there are sort of offsetting factors. So it's I like to call it, it's a bit like a sine curve. Something is going up, something is going down at all points of time. So tech is dragging down right now. Consumer is looking slightly weak. I'm not saying collapsing, but slightly weak. But at the same time, the whole capex cycle, spends out there, credit growth, all of that is looking strong. So we'll trudge along.
All right, what's the pecking order, Dheeraj, then? I recall in the past you've said, I think SBI, Axis Bank and ICICI Bank, I think they were the top stocks that you were interested in.
Yeah.
Does HDFC Bank get a mention in there, or would you stick to these top three?
So I would stick to this top three. HDFC Bank, I mean, it's consolidated over the last 2.5 years. So it's certainly looking interesting. So valuations are no longer as stretched as at what it used to in the past. And there's a sort of a divided street on HDFC Bank at this point of time. Do they go back to the glory days and become the premium sector, premium position again, or does ICICI Bank take that spot? So ICICI's consistency of delivery is absolutely outstanding. So between the two, if you would still force me to pick one, I will say ICICI. It's like the wall.
Okay, all right. So we got that banking, query out of the way. But we were speaking about auto stocks as well earlier this year.
Yeah.
And I recall you mentioned from the two-wheeler space, the Royal Enfield is something you like, Eicher Motors and Tata Motors.
Correct.
How do you approach Eicher Motors in particular? Because suddenly you have, competition that's coming in there, which has a bike lover. I never had that. I mean, and from a shareholder's perspective, suddenly they're looking at Bajaj Auto, Hero MotoCorp, because they're going to give it a bit of a challenge with the tie-ups that they've done. Would you buy Eicher on the dip?
I would buy Eicher on the dip. I'm sure some challenge was bound to come. It's not a surprise. Eicher is like Mr. Bajaj actually said it in public, right? That Royal Enfield is a bank and we're out there to rob it.
Yes. Yes.
I mean, why not?
He knows how to make these statements, right? That stick.
Right. So everybody's talking about it. And Eicher took a beating as soon as Triumph and Harley-Davidson pricing got announced. But at the same time, we have seen this competition trying to nibble at Royal Enfield before. So RE has got a nice definitive niche in pricing. And more importantly, they are creating a completely new segment in the global market, in the 350cc to 450cc or 500cc range. That doesn't exist. So they're actually literally expanding the market, and they're doing it very well. So I think Eicher will do well. I'm not saying competition will not do well, but it's a huge market, right? So I would buy Eicher on the dip, yes.
I was debating whether or not to go ahead and buy the Bajaj Triumph. I haven't yet got to test ride it. And Sunny, a friend of mine, said that, but Nigel, there's a 750 that's coming in from Aicha in the next 18 months.
Yeah.
So what about that? So I was like,
Problem of plenty, right?
Yeah. Good news.
Good news, definitely.
But there you go, you're waiting for Aisha. That's good news too.
But you know what? This also speaks a lot about not just demand, but even demand for electric vehicles, right? I mean, anyone and everyone you talk to now is looking to buy the next EV.
That's right.
So what do you do as a stock market observer? Do you pile on to EV stocks, or do you think that story has largely played out? Not just Tata Motors and Maruti, but some of the auto ancillaries as well.
No, I think that story is a long way to go. So EV conversion will keep on increasing. Somewhere slow, somewhere a little fast. So Tata Motors has done a phenomenal job in the four-wheeler EV space, 80% plus market share of a small market arguably, but still 80% plus market share.
Sure.
And the group is now foraying into making batteries and investing in tech out there. What if they do some kind of a breakthrough cost reduction in the whole battery technology, which is the most expensive piece of an EV, right? So I would continue to invest in EV and look for EV investments. I mean, obviously, some parts of it might be a little bit of expensive or bubbly, so the valuations have to be kept into mind. So TVS's EV strategy is fantastic. Maruti yet to completely get there, right? But Tata Motors has done really well. So there are all, in iShares case, obviously, that kind of segment, there is no EV yet. So they're a little bit of, in some sense, they're shielded from the EV conversion. But let's see for how long.
Dheeraj, you mentioned consumer looking a little weak, and you said IT also is on the weaker side. But those are areas where maybe not IT so much, but consumer is where, at least at the lower end, you can find stocks which are actually which have been bombed out. I mean, actually we had someone on Friday. Hiren Ved was with us of Alchemy, and he was saying that he'd buy some of these, lower end of the consumption space where perhaps there could be a recovery. Would you bet on that kind of a thing? Because
so I'm not,
at least the price is on your side, maybe.
Yeah. So I'm not so on top of the smaller consumer names, but the larger consumer names are not really cheap, right? And there again, within the whole consumption basket, there is no one single story which is playing out. So the paints volume are still doing well, whereas we saw FMCG volume struggling a tad. In consumer discretionary, there are some segments which are doing well, some not so well. So, India has become, from that point of view, a very, very diverse
QSR,
economy.
for example. I mean, names like Jubilant Food, etc., which have been languishing for a while. Would you want to take a bet on those kind of names?
I think it might be a bit early. The valuations, I don't think, are still down to a level where they become compelling. And QSR's valuations, with respect to its own history, has to be seen in the backdrop of competition from aggregators like Swiggy and Zomato, right? So Jubilant pre-Swiggy and Jubilant post-Swiggy are two different stories. Earlier, when you thought of a food delivery and you wanted food within 45 minutes, you would just say, at least it's reliable. It'll be at your doorstep in 30 minutes. Now you think of which food category to choose from. And second, even if you think of pizzas, then you say, okay, maybe today I should try Smoke and Joe's. Because Swiggy can deliver it, right, within the same 40 minutes. So you
continue to remain positive on Zomato. I recall in the past you were quite positive on it, right?
Yes.
So hold on to that view.
Yes.
Okay. In fact, I should tell you, Swiggy and Zomato now, Swiggy, of course, has Instamart,
That's
right? And a lot of the other players have it too. Literally in like 5 or 10 minutes, you get groceries delivered to your place.
Yeah.
So forget about food, right? I mean, groceries are coming to your house like in 5-10 minutes.
Yeah, I ran out of soda at home on Sunday when I was hosting a brunch, and I just installed 5 minutes.
You can invite us next time.
Interesting one.
Will do.
All right. Thanks a lot for joining in. Appreciate your thoughts here.
Thank you so much. It was a pleasure coming.
Thanks, Dheeraj.
Thank you.
Okay, by the way, for the markets, it is now taking a little bit of a dip into the red. So just keep your eye out on that. All 4 indices are in the red. The Sensex, Nifty, Midcap and Bank Nifty. Nothing alarming, but just slightly subdued. And what's exerting pressure on the markets is definitely Reliance, down 2.5%. Kotak is also down. And JSW Steel, Tata Steel are a couple of other companies that are in the red.
The Bank Nifty, Sonia, that's the one that's recovered a goodish bit from the low point of the day. So I think if we get the intraday chart on that one, it'll tell you the picture. The Nifty Bank, from being down, I think, more than 100 points, it's seen a bit of a recovery from the day's low. So that's good news as well.
Okay, well, let's move on then. JSW Steel, as I said, was a stock under a bit of pressure, down almost about 2% or so. The company reported a solid set of Q1 numbers, benefited from the lower input costs, while there was a big improvement in the overseas operations as well. Nigel had a chance to speak to Jayant Acharya, who's the Joint Managing Director and CEO at JSW Steel. He began by asking him about their realizations, which were higher, and also the EBITDA per ton. So let's listen in and we'll come back.
Yes, so our results in terms of EBITDA per ton is on a consolidated basis. So we have declared results on consol basis, and our EBITDA per ton is 12,345 rupees per ton in Q1, which is slightly higher than the Q4 numbers. The India results on a consol basis include our operations at BPSL, and that number is about 11,800 rupees per ton. EBITDA. The prices in Q1, we have been able to, while the prices did correct internationally as well as domestically, we were able to set off some of that with a better export booking, which we had in the earlier months, which went into Q1, and also a better mix of value added and geographical mix, which we could manage. With that, we have been able to get a realization which is slightly better than Q4.
So two-part question then. Could you tell us prices as of today, how does it compare with the average of the past quarter? And also coking coal cost, you had alerted us that it's likely to go up in this quarter in comparison to last quarter. How much higher has it gone?
So coking coal prices last quarter was about $274 for us. And in this Q2, we expect it to go, in Q1, it has gone up to $285 per ton. So it's gone up by $11.
All right. And realizations as of today, how does it compare with the past quarter? And coking coal as well, will it slide from this $285 per ton?
Yeah, so realizations past quarter, I would say the price corrections, as all of us know, has happened in the global steel industry per se, and that has been reflected in India as well. The exit numbers of June have seen a better part of correction, and it will part of that impact will be seen in the July-September quarter as well. But the coking coal prices have corrected, and therefore the cost will therefore go down, and we expect a $45 to $50 drop in coking coal prices going into Q2.
Okay, so EBITDA per...
which will offset any kind of price impact there.
So EBITDA per ton then will improve from here on, right?
I would say that we will be able to, margins would be range bound. It would be difficult to comment exactly on how the prices would move, but yes, I expect prices to have bottomed out, and so therefore the margin should be range bound.
Now, US and European operations, out there, if I calculate, the EBITDA has come in at more than 550 crores. That's much better than what we have seen in the past. Do you expect this US and Europe operations to continue delivering the 550 crores on a quarterly basis?
So you're right, your overseas operations did quite well in the last quarter. Our overall overseas EBITDA was 570 crores. Baytown, the plate mill, delivered good numbers with an EBITDA of $45 million on better volumes. In Ohio, also, the capacity utilization went up. So from a negative EBITDA last quarter, we have become positive, $2.6 million of EBITDA in Ohio. Again, on the back of good volume and capacity utilization. In Italy, again, very good numbers on the back of rail orders, on back of a good capacity utilization of 88%. The overall EBITDA at 18.6 million euros have been very good. So the overall overseas have therefore been very supportive. Having said that, I would also like to say that, as we know, some part of the global headwinds exist, and some price corrections which have taken place already may play out in this quarter. Also, there's a holiday season during July to September in various parts of the world. So therefore, there could be some impact of that playing into this quarter.
So what is the run rate we should work with then for the overseas operations?
It's difficult to give a run rate, but I would say that Italy will continue to do well. Italy has good orders in terms of the rails from the Italian government and from international export orders as well. I expect the Baytown operations to do reasonably well because the renewable sector is consuming a lot of plates. The Ohio operations, because the prices have gone down, while the capacity utilizations will be better, there may be a pressure on the margins in Ohio.
Got it. All right. There was this other article a few days ago that said that JSW Steel is looking at picking up 20% stake in a coal mine in Canada. Do you want to clarify on that? Are you all interested? If yes, at what valuation?
So we are looking at raw material security, and our aim is to have iron ore security and coal security as we build our capacities in India. We are also looking at metallurgical coal assets in the world, good metallurgical coal assets in various parts of the world, including Australia and Canada. Tech is one of the assets we have looked at. However, there is nothing at this point of time I'm able to comment. It's just an initial kind of a feasibility study which we are doing. So as and when we are in a position to give any comments, we'll come back.
Where is that NMDC Steel bid now at? You all were interested. Where has it moved?
Yes, so we have filed our expression of interest and the data room has opened and we are having access to the data. So the study is going on right now and we will take a decision at the right point.
Will you be willing to pay $1 billion for $1 million?
It will be very difficult to comment on any kind of payment or valuation at this stage.
Okay.
The data room numbers are just coming in. We will have a look at all the numbers which come in and then take a view as to what we can do.
All right. Final question then. What about the debt number? Where is it headed from here? On a quarter-to-quarter basis, there's been some increase. At what level, absolute level, will the debt number peak out?
So there has been an increase on account of some of the working capital increase which has happened. Two reasons. One, we have paid high cost metallurgical coal imports. We have paid out and that has gone into the working capital. The second one is some inventory additions which have happened in Q1 due to channel destocking and some impact which we had on sales due to the cyclone in the later part of June. So some of the material has got held up at the ports. So this has gone into the working capital. We expect once the merger of JISPL is completed, we expect about 3,000 crores of debt to get consolidated. However, we are looking forward to reducing the working capital impact which has gone up. And therefore, the date closing for this year would be in a situation better than what you probably see today.
Okay, that's JSW management chat. Just quickly want to highlight what's happening with Emphasis. The stock is down 4% now. So I was pointing out to that IIFL downgrade which has come in this morning. So that is the one which the market seems to be paying attention to, not some of the upgrades on the other side, which have been actually based on minor tweaks, multiple tweaks, etc. Multiple tweaks, but that's a large cut on a widely tracked name, Emphasis. And CreditAccess is the other one which will come up on your screen next. That seems to have cooled off quite sharply actually from the day's high. The high was 1426 and we've given up almost $50 from the day's high. Stocks at about 1383, still 5% on it though. We'll take a break here. You'll actually hear from the CreditAccess management, Udaya Kumar Hevar, Managing Director and CEO at CreditAccess Grameen, with us in a bit to talk about the numbers. And then we'll have Sanjay Agarwal, Managing Director and CEO at AU Small Finance Bank, also joining in to discuss their quarterly performance. Stay with us.
Welcome back. This is Corporate Trader. Well, let's get straight to the management of CreditAccess Grameen. The stock is surging after reporting a very, very good set of numbers in the first quarter. Net interest margins come in at the highest we've seen in 3 years, while asset quality as well has improved, aided by write-offs. To discuss more on this and their performance as well, we're joined by Mr. Uday Kumar Heber, the MD and CEO of the company. Good morning, Mr. Heber, and congratulations on a very, very good set of numbers. Couple of questions first. Could you tell us whether the tenor of the book has reduced in the first quarter if I compare it with quarter 4? And also, do you want to up that AUM growth target that you had given us last time of around 25% because of such a solid start in quarter 1?
Yeah, there is no change of tenor in our book. It's as usual. We had about 29% 3-year tenor loans, which remains same as of Q1 also. And on the guidance, it's actually definitely it's a good quarter. We actually grown with the customer acquisitions, grown with the good disbursement compared to YOY. We have a very good numbers across. But we want to wait one more quarter to see and then review if there's a change in our guidance. But at this point of time, we are sticking to our guidance and we'll review after a quarter. We definitely observe a very good trend, and not only for the company, even for industry, we feel that this is going to be a good year.
Okay, all right. So you're sticking to 25% for now. Just one more question on your book. Geographically, you seem to be spreading out a little bit from your core home states. What's the plan going ahead?
It is a continuous process. We keep improving it. Actually, for last 1 year, our beyond core market, we increased almost 25% now. 24%. Customer level, it's about 33%. It's very, very good, actually. So I think, it's a continuous district-centric approach. We keep adding districts around our operations. Contiguous district approach helps us in building a strong book with quality, replicating our operation very well. We continue the same process. This will be, as usual, by next 3 to 4 years, the core market should come down below 65%.
Okay. Mr. Heber, good morning. I wanted your thoughts also on what's happening with asset quality. There is an improvement this time around, and your asset quality, your gross NPAs are under 1%. But because of the inflation situation, because of the floods, has there been any stress at all in the book? And if yes, what would the asset quality range look like by the end of the year?
No, actually, there is no any significant issue anywhere in the country, anywhere in our operations. Our asset quality improved further. And even now with that below 1%, we have little legacy book of the acquisition actually. If you take out, that's actually much less than 0.7% is our gross NPA. If you look at at a 90 days basis, it is just 70 bips, not even 89 bips. Because we consider NPA at 60 days basis. So I don't know whether you are aware about it. Actually, no. So therefore, asset quality is quite good. What we guided is 1.6 to 1.8% is our credit cost, and we are definitely within that. Yeah. We'll be able to maintain within that.
Okay. Another, Mr. Heber, hi, good morning. Another data point which was being highlighted is that the share of unique customers for you has fallen from 43% to 34%. So the share of customers with 2 or more other lenders has gone up quite substantially. How should one read this data point? Does it lead?
It is slightly changed because as we go to newer markets, we acquire customers. We may be a part of one customer, one lender already. So therefore, as you grow more and more beyond our core market, there's a higher chance of acquiring from other customers. Competition will play definitely. But the important point to see is within 12 months' time, if you see, almost 11% of customers actually slowly leaves all MFIs and becomes unique customer for ours. So that's actually, it will keep on, we keep on lending more to other customers. We keep on acquiring the customer from different geographies. So if you look at more than 3 lenders, I think it's hardly about 11% or so.
Just to, it doesn't in any way indicate to any potential future stress. High indebtedness and then...
Not really. What happened is the regulator removed that cap earlier. So earlier there was a cap. Now there is no cap. Now any lender can go and lend to the customer whom we already lent. So I think that one change can increase the number of lenders. But in the meantime, regulator also put a cap of the FOIR, not more than 50% obligations to be maintained by every MFI. Therefore, this process, there is a good customer protection by every lenders. Therefore, if there's a more than 1.5 lakh unsecured loans, we don't lend to them. So automatically, we ensure that the asset quality is protected.
All right, Mr. Heba, the other bright spot of your numbers was the NIMs. Came in at around 13%, the highest in multiple years. So that's pretty good news. Now, I'm aware that, the rate that you are giving out loans has gone up a little bit, but your cost of funds as well has gone up. So taking both of that, on board, what could your NIMs look like from around this 13%? Should we see it tapering down a little bit? And for FY24, what should it look like?
So we guided 12 to 12.2%. Yeah, as I said, it's actually good improvement. And we expected some more cost to go up in this quarter, but fortunately we are able to control that. Therefore, NIM looks a little better. But as we use the capital, it will come down a bit. So because of the change in the overall capital adequacy. But still our guidance is about 12.2. We will review after a quarter. Maybe it may go up to 12.5 if everything goes well.
Okay. And, you spoke about how your overall growth, you'll stick to this 25% growth guidance. But I want to understand on the customer acquisition and loan growth, on an average, what are you looking at? I mean, what would the normalized, say, compounded growth be over the next 2 to 3 years? Will it be at 25% or would it be lower than that?
So actually, we guide about 20 to 25% in terms of portfolio growth, and as well as 15 to 18% customer growth. And actually, we guided almost, next 4 to 5 years, we should be able to reach a 50,000 crore portfolio book. So that is what we did guide in the last analyst meet on May 18th. We actually precipitated this, assuming that 4 to 5 years, we should be able to reach 50,000 crores for microfinance book.
So on the portfolio book, you're saying 50,000 crores over next 4 to 5 years. But any target that you have in FY24, it will be about 18% growth in your customer book. That's what you're saying?
15-16% customer growth and 24-25% portfolio growth. Have we already guided? So we will be able to achieve that.
All right, Mr. Heba, the last time you joined us, we had quizzed you about the promoter entity looking to bring down their stake, and you said that could be likely in the coming year. Our viewers as well as your shareholders remember that, and in the coming weeks you went ahead, the promoter entity has diluted close to 5-6% odd. Are they done, or will the promoter entity dilute further? Because I think the earlier guidance was around 10% odd is what you want to bring it down by.
Correct. So if you look at, it was one of the requirement what we have been requesting the promoter, if we can reduce a bit, which can help us to enhance the investor base and enhance the floating shares, which largely we done, including the promoter stake sold about 5.7% and about almost close to 2% based on the swap. With the last leg of the acquisition, I think overall almost 7% has been already diluted. Your floating shares almost 33%, which is quite good currently. I think, largely what we intended to do has been completed.
All right, Mr. Heba, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts. That's CreditAccess Grameen. The stock is up almost about 4%. So they're talking about a good growth in excess of around 20 to 25% overall, and also a 16 to 18% growth in the customer book is what they're looking at for FY24. So that's CreditAccess Grameen. But let's do one thing. Let's get a handle on what's happening in the market now. Very quiet, actually. Not too much action as far as overall movement is concerned. Let's take a quick break and we'll come back with lots more.
Okay, well, AU Small Finance Bank is with us as promised. The stock is slightly lower in trade. The numbers came through. Net interest margin is the slight bit of niggle here. We've got the management joining us, Sanjay Agarwal, Managing Director and CEO at AU Small Finance Bank. Mr. Agarwal, great to have you with us here. Good morning. Pleasure having you with us here on CNBC-TV18. You know, on all parameters, the numbers look pretty good. The one niggle, as I pointed out, seems to be the NIMs, which have contracted. Can we start there, sir? What happened?
So, Prashant, it's very natural back in this high interest rate regime, right? And we are a new bank, we are just in 6 years of our journey. So, when you're in 6 years of your journey, right, so you need to do something for your customer to really raise deposits, right? So, in that sense, I'm sorry.
Come on, Mr. Agarwal, we can hear you.
Okay, it's all right. So I'm sorry for this. So Prashant, we are a new bank in the journey of, right? We're just 6 years old. So we need to price our deposits, in terms of the other established bank, universal banks. We need to price them better, right? Otherwise, people won't give you deposits as of now. It could take some more time to build brand, product, service, all those things. So, and in this high interest regime, it will naturally happen, right? And we also deal with the customers who we don't deal much on floating rates. Our 65% book is your fixed and 35% book is your floating, right? So it takes the challenge. But I think last quarter we also had surplus liquidity. So I think NIM pressure was supposed to come. I told my entire ecosystem that last year itself that this interest rate cycle movement will happen, for next 12 to 18 months, and we are into the cycle now, right? So, but it is for me now. There is a pause on interest rates hike, as of now, and I believe that once it gets reversed, so we'll get more benefit out of it.
Okay, Mr. Agarwal, good morning, and thank you for joining us.
Yeah,
but
good morning.
You see more pressure because it's not that the pressure was not expected. As you said, everyone knows that cost of deposits went up. But this is from your highs, 6.3, you've come to 5.7. It's a 60 bips fall. So is there more?
No. Lata, so it has a two aspect of it because, we started commercial banking lending also, which is not a higher rate. We just lend around 10-11% in those assets also. So the mix is also getting changed. Of course, the benefit of
mix is getting changed. Mix is getting changed in favor of what? Large corporates?
No, that's we can't do that. Large corporates, right? We're still a small finance bank, but our 90% is retail asset, right? 10% is that. But in the sense that we were dealing around 25 lakh to 50 lakh kind of loan where we deal around 14 to 15%. But the moment we moved around 1 crore to 5 crore bracket, we can't price that level, right? We need to price it at around 10-11%, right? So that's why, in last 2 quarters, it was around because of mix getting changed, And now, in a high interest rate regime, we need to borrow money, right? We need to take our deposit to the next levels. It's a mix of both the things, right? And I expect that most of that has been arrested by this quarter now, but there may be a case where, if there is a hike interest rates going forward, then again, there can be pressure on NIMs. But largely, I will say we have already covered largely in our this quarter only.
Okay. The other point of bother could be that in the interest to keep your margins, you go in for high risk, high return assets. And that may be showing already in your slippage ratio. It's slightly higher. As well, your GNP is about 10 basis higher. Is that a worry now? Especially, unsecuritized loans are the first to get impacted by higher interest rates.
No. Again, Lata, one thing I can assure you people from this platform is that we are known for our asset quality only, right? So there is no concern around it at all. I think it's more cyclic. We were around 1.66 in March, which is too good a data, right? And then it has to go a little bit here and there, which is 1.76 as of now. So there is not at all any worrisome there. Second, we don't do much unsecured, right? We have 1,000 crore of personal book and maybe 1,000 crore of our credit card book. Other than that, this entire piece is secured, So close to 95% is secured, right? 90% is retail, right? So I think we should not read much around it. There are certain slippages, which is very normal in course. The first quarter generally happens like this, And this is the first quarter, after COVID and all those things, which is now getting stabilized, right? So I think we should not read much around it. We are absolutely in control of our asset quality.
Okay. Okay, that's good to hear. It's just that CIBIL also was raising some red flags on lower denomination loans. They had also raised the red flag.
We do secure, Lata, we do secure. Again, I repeat that 95% assets are being secured. Secure in the sense from the primary security or a collateral one.
Okay, okay. The cost of capital never, I mean, the total cost to income has still inched up a bit. Is that the highest, or can we see it? You had gone up from 63, I think, to 65% in terms of cost to income. Will you see it receding? Is this the peak?
Yes, I would say again, we'll keep investing in this franchise. We have built the whole digital franchise. We have built the whole commercial banking franchise. Already built a very decent branch banking liability franchise. Now we need to build the TBG group because we just got the ED1 license last quarter only, right? So I think the investment in the bank will continue, Lata, because I strongly believe that generally bank takes around 10 years to really be at size, scale, and stability, right? And we are just 6-year-old now, right? So give us some more time, right, to stabilize it. But because 1% here and there, in a discussion looks very high. But once you do in operational level, right, 63 or 65 doesn't have much difference around it. So I would think that it would be in a similar level the way we handled last year.
Yeah, but you said, banks take 10 years to stabilize. Do I hear an ambition to apply for a universal bank license then?
So, Lata, again, I would say, as I repeated many times, that we are playing our inning, right? We have to play on the platform which has been given by this country and the regulator, and we need to apply ourselves to the core of it, and it's up to the regulators and the country to decide.
No. I'm just asking if you will apply. Will you make a request anytime?
So aspiration will always be there, right? Because, when a cricketer played a Ranji Trophy, you want to play a test match, right? When he played a test match level, you want to play at world level, right? So I think the topmost platform is universal bank, right? So there's no deny of it, but we are not in a hurry. We might take our own time and we do the core of this platform, right? And then look for that.
Okay. No, I'm asking you because your capital consumption has been a bit significant, 2 percentage points reduced on CRAR, though it's still very high at 21%. Would you look to raise capital because at least the stock markets are very kind to financial stocks?
Not this year, Lata, not this year, because we already raised some good amount of money last August. So not this year, not this year.
Mr. Agarwal, just to kind of circle back to the point on margins. So what are we looking at, sir, for FY24, if you can put a number to it? And also on some of the other parameters like loan growth, what should we expect in FY24?
So, Prashant, I would say that we want to repeat the last year performance and we really want to remain very cautious because I know because I'm in the industry for the last 28 years, and at good times, certain time you make mistakes, right? So we want to have 3-4 clear-cut strategy which says that deposit-led growth. So we really want to grow our deposit in the range of 25 to 28%, right? And then we really want to grow our asset in the same range. We want to have our profit growing by at least 25%, right? And I think this is the larger things, but I think in terms of content, we really want to operationalize our ED1 license. We really want to stitch our digital bank again. We really want to have one more vertical in the bank, which is for rural and impact banking, right? So I think these are some other content where we are working on because generally we discuss only about deposit, asset, name on this course, but I think there are so much of other content also in the bank, and we are very new on the system, right? So
absolutely. Just so a 25 to 28% growth in deposits and advances. You said you'd like to maintain margins around the last year levels. That you were just under 6% last year. So
so there would be some leverage, and I would say you say NIM. I would say in the range of 5.5 to 5.7. We want to target it, but I think the other income can play a very important role this year. So we might have similar level of ROE and, of course, the profit growth.
Oh, other income in what sense will give you more money?
So I strongly believe that insurance income has got rationalized.
Okay,
That
okay,
will be the one uptake. Then we will operationalize our AD1 license. We are now
okay.
close to 4 million customers. We will cross-sell them more. Our productivity will go up because we are not hiring too much nowadays. So I think all put together, I think I strongly believe that we should do the same return ratios like last year.
Okay. Oh, that's good to hear. Ultimately, that's what investors want. Thank you very much,
But
Sanjay.
it's very long-term journey, right? So
Of course.
quarter to quarter doesn't have any meaning for me, to be honest, because I
Fair
strongly
enough.
believe March
That would be
27
true.
has to be-
That would be true of all corporates. That would be true of all corporates, Sanjay. But the law of the land requires a quarter-on-quarter result reportage.
Yes.
Thank you very much indeed for joining us, and all the very
Thank you.
best.
Thank you. It's always fun talking to you. Great.
Okay.
Thank you.
All right, so the quarterly result, of course, did show both on asset quality and on margins a bit of a hiccup, and that's what the market is reacting to. We take a quick break, and we're going to be joined by the RBL Bank management. Subramanya Kumar, Managing Director and CEO, will be with us. Welcome back. It was a bank results weekend, as you know, and one of the banks that's got a very positive response from the markets is RBL Bank. Posted an all-round positive performance in the first quarter. Advances and deposit growth, asset quality, return ratios, whatever you want, was better than what it was a quarter ago, and some of them even a year ago. Well, we can crib about margins, but the market clearly is giving a thumbs up as of now. Joining us now is R. Subramanya Kumar, Managing Director and CEO of RBL Bank. Good morning, Mr. Kumar. Thank you very much indeed for joining us. Well, let me start with the one thing about which we will express a disappointment and then come to the positives. The margins are down, not much, 17 basis points compared to last quarter, and still significantly up compared to a year ago. Will you be able to stabilize at 4.8% levels?
Yeah, absolutely, Lata. If you look at it, it is mainly because of the deposits repricing, the majorly which has been taken place right now. If you look at the majority of the repricing has already taken place, going forward, maybe a very small repricing would like to take place in Q2. But this is going to be offset with the advances which we have already done. Our current margin will keep inching up by 10 bips by next quarter. Thereafter, it will catch up with 5%. And on average, we will exit with around 5%. And thereafter, it is going to be a positive quarter on quarter.
Okay. Let me come to the more longer term question. What are you doing different? RBL until recently was run by, well, almost you can say founder, though of course it was an old bank, Ratnakar. It was run by Mr. Ahuja. What have you changed in terms of running the bank?
So the major change what we have brought out is the strategically driven by the board and execution by the management team. The one big change which I brought about was that looking inward with regard to the capabilities of the organization. And I should definitely give a credit to the entire team. The depth of knowledge and depth of execution capability is well entrenched into the organization. This is one I started reaping it. The second was the branches. We have around 520 branches and 1,100 to 1,200 BC points. So we wanted to leverage those points who were hitherto doing a single product or single product line. Now these have become a sourcing point for all my retail as well as the new products which we have launched in last 6 months. And one of the major change what we brought about was that having a lot of shelf products, we were looking at the products which are there on the shelf which can be retaining and the stickiness of the customer. Second, we have started building up a lot of products which will going to add up to my balance sheet. You would have seen the retail products which we have launched in last 6 to 8 months started scaling up so well, and they will all become profitable in 12 to 18 months. And this you can easily observe that they will unlock the overall profitability of the organization.
Okay. No, but your cost to income ratio, although, you know, it has improved, it has fallen compared to a year ago and quarter ago, is still compared to other banks, 66.5 is high. Are you working with an internal target? If yes, what?
Yes, in fact, one of the ways we work is expenditure has to be there for an organization of this size, OPEX, and we are investing in the products and manpower and everything. Most of the investment has taken place in last 2 quarters, and there will be an incremental expenses as we move forward. So one tilting factor was that previously we never had an interest revenue to substantiate or support this cost. Now you would have seen that we moved up from 15% NII to 21%. This NII will keep move up from 21 here on. So with the cost being more or less contained in the same level, of course the expenses will be incurred. I can't say that it's going to come down, but the cost to income ratio will start looking downwards, southwards. So the couple of points we will be bringing it down from the current level. And one of the major cost optimization efforts which we have done started showing lot of results to us, and we will continue to optimize our investment in technology and investment in the manpower. The productivity is one of the area where you can see much more than what we have been seeing it today, which will add up to the income, and it will just optimize our cost. So we are confident that we will be in a position to bring down the cost to income ratio a couple of percentage points during this year itself. And year on year, with the income kicking up, we will be in a position to bring it down much lower. So
60, 61, 62%, Mr. Subramania Kumar, this year?
May not be to that extent, maybe in the range of around 2-3 percentage points less than what you have been seeing it now.
Okay. You know, just to pick up on the earlier point, which my colleague Lata was talking about, which is what have you done differently? Now, one of the ways I'm assuming, you know, a lot of people will judge the success, etc., is, you know, the ability of the bank to attract fresh, top quality talent from elsewhere, and whether, you know, they're willing to come on board this, you know, the new direction that the board at RBL has now set for itself. Have you been able to do that? Anything you can tell us?
Yeah. See, as far as that the attraction is concerned, we are able to attract the talent where we require. See, for example, we have already signed up with a CFO who will be joining us in a couple of quarters. And we had a CIO who has also joined from the Barclays, with the background of the Barclays and other things. And see, we firmly believed about one fact. creating an opportunity for the people to move up within the organization, which has panned out very well. If you look at our retail, the retail 158% is the growth in the disbursal over a period of 6 to 8 months time. It scaled very well, our housing loan and mortgage loan. And two-wheeler and four-wheeler also, we have attracted some good talent who are heading those verticals. And these, all the requirement for rolling it up is in place, and you will see that scaling up there. So where we require a talent, we were able to attract it. For example, our corporate operations center, we are headed by a very senior guy who was able to bring in a lot of efficiency improvement. And the HR, we have just provided from internal opportunity to move up, which provided us an ability. I can just give a couple of examples of how these people have scaled up. Yeah. Launching around 6 to 7 products within a period of 6 to 9 months itself shows the capability of the internal team.
Got it. I just had to squeeze in one more question. We're running out of time. Could you guide us to what your targets on return on assets, etc., are? Could you is the 1% ROA? I mean, do we have visibility, and by when, according to you?
See, the quarter on quarter, henceforth, we will not go below 1%. You would have seen that we promised that in our last call also. We will be clocking 1.1% continuously every quarter. Today, we have closed with 1.01. Going forward, we will maintain it in a couple of quarters. And the last 2 quarters, we'll see the uptick in this. And most likely, we will exit with around 1.2, another 20% growth in this particular ROA.
So 1% with upside, basically.
Yeah, 1% with upside.
Got it.
Yes.
Got it. We'll leave it there, Mr. Subramanian Kumar. We're out of time, but thank you so much for joining us. Very confident sounding RBL Bank management with plans for the medium to long term. The bank seems to be on a strong wicket in terms of mend of its balance sheet. We'll take a very quick break here. On the other side, our special segment, Market Masters. Lata will get chatting with Ramdev Agarwal of Motilal Oswal Financial Services to get a sense of what he's making over the market days, where it is headed. Stay tuned for that conversation.
Welcome to this very special broadcast of Market Masters. We have a Market Master, Ramdev Agarwal, the chairman and co-founder of Motilal Oswal Securities. And there is a reason why we've called him. The indexes are at all-time highs. 20,000 seems round the corner for the Nifty. The mid-cap and the small-cap index, after a long gap, have notched up significant gains. And what is more important is that there isn't even one foreign brokerage left. Every one of them are queuing up to give more rosier picture about the Indian stock markets and the economy. So is this a damn good long-term story, or is this a point where everyone is confident, so we should worry a little? For a person who has seen all these kinds of cycles, these questions would be very important. Ramdev, thank you very much indeed for joining us over here today.
Good morning and welcome to this morning. Yeah.
So I wanted to ask you first about this, a positivity. Mid caps, all-time highs, small caps, all-time highs. Are you first worried that there is a bit of an overdoing in the near term, a froth?
Yeah, so I had anticipated this in the sense that didn't know about small, large and all, but I was knowing that one day foreigners have to join the, this party, because domestics since COVID, because of massive onboarding of retail from 30 million to 120 million of your accounts, that has, SIP boom is on at 15,000 crores per month. So that was, that cushioned the sell-off by foreigners. Yes. Now that journey is still on. Retail is still on. Yes. And on top of it, now foreigners also want to buy in. Yes. First, they want to buy in what they have sold. And then they want to top it up, because now India is a far more important market in the global scene at about almost close to $4 trillion. We have 4% of global GDP. Yes. And even market cap wise, almost $100 trillion is the market cap worldwide. We're at about 4 trillion. But yeah, about 4 trillion. So we're again 4%. But their allocation is nowhere at aggregate level. Their allocation may be about a percentage or so if you see the total number. So I think there is a lot of gap between what they should be allocating in the years ahead and decades ahead. Then what is the allocation today? Whether they take the call today or they take a pause and then come after 3 months or 6 months. But I see on a 5-year, 10-year basis, one way FI flow. I mean, of course, we have to play our part of it in terms of corporate earnings and other things. And actually, there is a likelihood that market may re-rate to a different level altogether, in the sense that from 2021 P multiple, because the only way you can accommodate flow from both sides is either there is a massive boom in the paper flow from the corporates, or the market itself re-rates through 25, 26 times before, and then of course paper flow will come. So that's the kind of situation right now. Something may change.
Okay. That's an excellent start to this conversation, because these were the questions I wanted to ask you. At the moment, what do we worry about Nifty? We worry that it is very close to its long-term average. Or in fact, higher, 1.5 standard deviation above its long-term average. But in euphoric times, it can go even to 21, 22 times. Yeah. So do you think that we should be worrying now that we are, above the long-term average? Can there be a sell-off before that?
Yeah, I mean, see, there's so many moving parts. But I think most important the corporate earnings. We are right in the middle of the season.
Okay, how do you measure that? Are you happy with?
Yeah, so far, not many disappointments, but actually the banks have kind of really been fantastic. I mean, way beyond any analyst estimates. So I think you've seen the last, on Saturday.
Yeah, I see.
There was a lot of, everything was around 50% kind of a growth. And the analysts will still say there will be 17% for the year. So I think that's where the thing is. And even the cost inflation which happened because of post-Ukraine and last year commodity inflation and all, that is yet to, pass through. And I think most probably in September quarter, you'll see even more dramatic fall in the raw material cost, and hence margin expansion for the non-financial companies, consumer companies or cement companies, steel companies. You see margin expansion. So
you would say even entering at this time or continuing to increase your investment. I mean, I guess everyone is invested.
Yeah.
But continuing to top up would be your game plan?
Yeah. I mean, don't bother too much about the market levels, because this all-time high is for last 75 years. It is not for next 5 years. Okay. We are going to see significantly higher Nifty, Sensex in next 5 years. Almost, I would say, double from here.
So no red flags in your mind?
No, red flags means you have to be cautious, because you can't buy anything at any price. You have to be careful what exactly you are buying. You do your research. And you are, in any case, topping up your portfolio in the sense that if you are 80% invested, 90% invested, you are finding an opportunity and getting into them. And I think from here, every company or every industry will move differently, in the sense that everything will not fall off. Okay. There is something which has run up too much, that will fall off, but simultaneously, if you see, something else will do very well. Like tech was falling behind the curve, but you see what happened in the last 1 month. Everybody was underweight on tech and they got punished. So I think the story will keep changing, and I think the whole market will keep, if both the flows continue and corporate earnings remain intact at about 25% current as predicted, I think we are in a good wicket.
Okay, I am going to come back to the market questions, but since you raised the issue of tech, I do want to discuss one or two sectors which obviously are important. Tech.
Yeah.
What would your personal view be? The guidance we got from Infosys was a bit, heartbreaking, shattering, confidence shattering. What's your sense? Is it already time to dip in, or do you want to wait and see how these things, how the cloud clears?
See, this tech has a, history of, it's a adaptive kind of a thing, in the sense that every 3, 4, 5 years there is a new thing coming in. Like Y2K came, people came for bodies, those who can quickly sort their problem. Then came the ERP boom. Then came the .com boom. Then came the, all this webs and everything online. So the 5G,
the
6G, digitization, now digital, then all this.
Now it is AI.
Now it is being talked that AI is yet another next frontier. So it is going to be different. It is going to be huge, but it is going to take time. Right now, everybody is trying to understand what they can do. And as the applications they come, I think the mandates will become bigger. Clients will also be clear what all they can do. And even the service suppliers, they'll also be very clear what kind of competencies they need to build so that clients can be taken care of.
So you personally are using this dip to buy?
I'm allocated in the sense that even before the dip, we were not grossly underweight or something like that, except that we were much more on the large mid-sized ITs for a growth differential. But basically, we were there because we knew that, because see, look at the today market moves. In US, it's only about tech companies. With those 5, 6 big companies, they are only driving.
So there it is, of course, a crazy.
Yeah. In India, it is led by financials. So someday, we will follow the tech, but our digital side has done very well. In the tech, all the digital companies which got hammered post in last 12 months, I think they have come back very well.
Which is what I wanted to ask you. I mean, Zomato, I have read your reports and you all are very bullish. Yeah. Do you think that there is a second coming for, the Paytms, Zomatos, Nykas, everyone who was a marquee name in e-com?
No, seriously, they have a second company. They are well funded.
But valuations are now...
Yeah. Well, it is very tough to figure out the valuation in a conventional way. Okay. See, if you do valuation based on P or something like that, there is no E. So what kind of P multiple you talk about? So it's all in the... first thing is it's the option value. Second, you have to also do a lot of adjustment in terms of trying to understand underlying value, in the sense that their books don't have any capitalization of any expenses.
That is true.
So that you have to adjust in some way and then try to see, or maybe you see, say 4 or 5 years out, if you have the courage to see 4 or 5 years out for these companies and try to do some kind of conventional P multiple. So, but this is the frontier. This new tech companies like Zomatos of the world or Swiggy or Policybazaar, Paytm, I think these are the companies which will, they are well funded, and I think they will have good time.
They'll cut fresh ground. Okay, let me come to the more conventional, the usual banking, the one that we should discuss because it's 40% of the market.
Yes.
Now, would you think that HDFC Bank, after the merger, may underperform because, there is a lot to lead? Would there be any worries? Would you rather bet on, ICICI or Kotak because of the fact that they have to carry a large load?
It's not about this or that. Every bank has its own merits. This is the most successful bank in the last 25 years. And they have created, and the CEO has gone on record saying that we'll create another HDFC Bank in the next 4 years. Yes. What more you want? Your index is going to do 12-13%, and they're guiding for 18%, I don't know, top line or bottom line. Okay. But clearly, and so I think it's an outperforming stock. That doesn't mean that there is no other bank which can outperform. Okay. So I think in their own merit, this needs to be looked at very seriously because there is no... everybody is kind of skeptical about their outlook, but look at what they've created and the way they are going about it. And this merger, post-merger, at the time of merger, there is a lot of readjustment of the ownership.
The worry is, I'll tell you what, we have always used to seeing HDFC Bank the best in margins among the big banks, the best in ROA among the big banks. Yeah. Now they are second in both these aspects with respect to, if you compare it to ICICI Bank. I'm not still bringing Kotak because they have, it's smaller in size compared to them. So, that worry is there.
But size, they are way above.
Size, they're way.
I mean, see,
they're double, I say so.
Yeah, the dominance in the marketplace, when you say that I'm at 10, 12%, 15%, 17%, you see in bad times. See, right, this is a good time. Yes. In good time, when the credit cycle is good, it doesn't really matter that much. But there is a little ripple in the economy, and then you see how this tall, big guys, they will stand up. And I'm not comparing HDFC with any other bank. I'm saying the HDFC alone, because they can't compare. Their size is different, their growth rate will be different, base effect is different. So,
but what about the disruption to housing finance itself? Because they were anyway very good in housing finance, and now you have cheap money, cheap raw material to boot.
Yeah.
So does that make life difficult for other housing finance companies? You should know it better. You have one.
No, I think they'll become super prime in the sense that it will be very difficult to compete with them, because now they have distribution of HDFC Bank as well as HDFC, and cost of money which is invincible. I mean,
life
the lowest.
is tough for other housing finance.
Yeah, so they knew the game very well.
Yes.
See, a lot of time what happens is that you are actually not that good in housing finance, but the one thing they know very well is the housing finance. So the kind of cross-sell they can do, so it's all promising thing, but how they execute on the ground, that we need to see over a period of time. But I think they will, other super prime lenders, they have to be really cautious on that front.
Okay, so that's a challenge to even the existing ICICIs and the
in the bracket.
Yeah, the bigger challenge to the non-bank space is coming from Reliance, Jio Finance. But that question after the break. Give me a minute, we are back. Bazaar audience, you will get to see the entire interview after market hours.
Yes.
Sir, I don't know anything about this company and this and that. Like, that's nonsense.